Thanks, Keenan, and thanks to Ben for having me, and pleasure meeting all of you. My name is Kareem Saleh. I'm the founder and CEO of Fairplay. We cheekily refer to ourselves as the world's first fairness as a service company. And our tools allow anybody using an algorithm to make a high stakes decision about someone's life to answer 5 questions. Is my algorithm fair? If not, why not? Could it be fairer? What's the economic impact to our business of being fairer? And finally, did we give our declines, the folks we rejected, a second look to see if maybe we declined somebody we ought to have approved? Our customers today tend to be financial technology companies that want the economic, regulatory, and reputational benefits of being fair. So some of the biggest names in fintech, Figure, Octane, Happy Money, Splash Financial, Lending Point, all use our software to automate their fair lending testing and reporting, and to run second look and decline management programs intended to increase positive outcomes for historically underserved groups. I'm joined on the call by my colleague Ray Hanley from our product department, and thought I'd just walk you through our tool. So with that, can everybody see a screen that says play fair, win big?
Yes.
Awesome. This is our website. Our users can just go directly to our website, click login. We have integrations with all of the major cloud environments, GCP, Azure, AWS, or you can just create an account directly with us. We always ask you what kind of financial product you're analyzing, a non-mortgage or mortgage, or sometimes folks choose to analyze marketing models. I'm going to show you all the non-mortgage flow today. So you click non-mortgage. You get prompted to upload your data either via one of these cloud platforms or perhaps locally. And the data that's required here is all of the inputs, outputs, and outcomes from your incumbent or prospective algorithm. You just click upload. I've got a data set handy. And for every data set you upload, you get a little card like this on your dashboard telling you what functions in our product you've enabled. So you can see that by dint of uploading this non-mortgage data set, we've enabled 5 functions in the product. The first is customer composition, like who responded to our marketing. For 50 years in financial services, we have tried to achieve fairness through blindness. So it is very uncommon for a lender, for example, to ask about or consider the race, gender, or age of a loan applicant, and yet you need that information in order to assess whether you're treating people fairly. And so the first function in our product is customer composition. Who did we lend to? Who responded to our marketing, and who did we lend to? The second function in the product is proxy detection, and that translates roughly into, are the variables I am using in my algorithm fair? Are they predictive of my target, but are they also predictive of protected status like race, gender, or age? The third function is fair lending analysis. How did we treat the people who applied? The fourth function is fairness optimizer. Could we tune our algorithm to be fairer? And the fifth is second look. Let's review our declines to make sure that we didn't say no to somebody we ought to have approved. Let me walk you through these quickly. Customer composition. This looks simple, but actually we were speaking with a top 10 bank the other day who told us it took them 9 months to implement the algorithm that allows you to do demographic imputation in the format required by the federal financial regulators. And so we use first names, last names, and street address to attempt to approximate the demographic class membership of each loan applicant. You can do this for borrowers as well. Once you know who's responded to your marketing, you generally want to know, okay, well, how are the variables I'm using fair? And so what you can see here is we plot every variable used in your algorithm on a 2x2 matrix. The x-axis here is bias. That is to say, how predictive of protected status, like race, gender, or age, is this variable on the x-axis? And on the y-axis is predictive power. How predictive is this variable of our target, right? So how predictive is this variable, for example, of default in the case of a lender? So you can see, for example, the credit score here, highly predictive of default, but also highly predictive of protected status, in particular, highly predictive of being either Black or Hispanic. Other variables like vehicle make, for example, less predictive of default, but also still highly predictive of protected status. So this tool allows lenders to make judgments about the variables they're using to assess people and to determine if perhaps they ought to substitute variables that are like vehicle make, which are only somewhat predictive of their objective, but also highly predictive of protected status. Once you've gone through proxy detection, you want to know, okay, well, like, how did we treat the people who applied? So you click on fair lending analysis. And what you can see here is we're looking at the fairness of the underwriting decision, but we could just as easily be looking at other key decisions that get made along the customer journey, like a pricing decision or a line assignment decision or a fraud detection decision or a marketing decision. And you get a nice little summary card at the top here telling you that the system did not detect any disparities for female applicants, but it did detect potential disparities for Black and Hispanic applicants, none for Asian Pacific Islanders, and some potential disparities for American Indian Alaska Natives. If you scroll down, this is the view for women, and you can see that this lender's current algorithm is approving women at 91% the rate of men. That's an improvement over their previous algorithm, which only approved women at 82% the rate of men. And it's also an improvement over what their fairness would have been if they had solely decided on the basis of a credit score cut that yielded the exact same number of loans. I should add, by the way, that there are many different definitions of fairness, and the federal financial regulators don't all agree on what definition of fairness to apply. The key ones that we generally tend to use are adverse impact ratio. That's a measure of demographic parity. It asks at what rate is one group approved relative to another. So at what rate are women approved relative to men, for example. But that's the measure of fairness that's commonly preferred by courts and the CFPB. But we know that other financial regulators like the OCC and the FDIC can prefer other definitions of fairness like denial to odds ratios or marginal effects. We can do this analysis for every protected group. So here is the view for Black applicants. As you can see, this lender is approving Black applicants at 79% the rate of white applicants. That's below that 4/5 or 80% threshold that courts and regulators commonly look to as potential evidence of disparate impact. Now, notwithstanding the fact that this lender is approving Black applicants at 79% the rate of white applicants, that is an improvement over their previous algorithm, which was approving Black applicants at 74% the rate of white applicants. And it's an improvement over what their credit score would have been if they had just decided on the basis of a cutoff that yielded the same number of loans. If you want to understand what variables are driving differences in outcomes for Black applicants, you just click on drivers of disparity. And we calculate Shapley values. And so you can see here, for example, FICO represents 18% of the disparity exhibited by Black applicants at this lender. The average Black applicant's income versus the median income in their metropolitan statistical area is contributing 12% of the disparity exhibited by Black applicants. And the co-applicant's Vantage score is driving 8% of the disparity for Black applicants. We also have really advanced mapping functionality, so you can assess your fairness all the way down to the census tract level. Let me just show you that real quick. So this is a map of the United States. This actually depicts the state of mortgage fairness to women in 2020, all the way down to the census tract level. So if women are approved at least 90% the rate of men, you see green. If women are approved at between 80 to 90% the rate of men, you see yellow. And if women are approved at a rate of less than 80% relative to men, you see red. As you can see, there's a lot of red on this map, especially in the South and the Great Plains. And here's what the map looks like for Black homebuyers. As you can see, there are many parts of the country where Black homebuyers are approved at something approaching 70% the rate of white home buyers. And by the way, we can do this analysis for every mortgage originator in the country. So you want to see Wells Fargo's fairness to Black home buyers? That's Wells Fargo's fairness to Black home buyers in 2020. You can also click on any county to see what their fairness is all the way down to the census tract level. So here's Miami-Dade. We just click Miami-Dade and we can see, for example, in Miami-Dade, census block 114.01, Wells Fargo is approving Black applicants at 43% the rate of white applicants. Going back to the tool real quick, if you want to prove to your regulators, your auditors, consumer groups that you've done this analysis, you just click on download. And the thing that people seem to really like are our executive presentations, which are designed by Seth Feaster, who ran the data visualization team at the New York Times. And one of the things that we really take pride in is that these executive presentations effectively have no text. They're almost all visuals. And you can see we have preserved a lot of the visual nomenclature from our user interface so that you don't have to be a fair lending expert to understand what's going on here. But now that we've identified the potential disparities and what's driving them, what we really want to know is, like, could we do better? And so that brings us to Fairness Optimizer. And what you can see here is we generate a plot of alternative algorithms that allow lenders to trade off profitability and fairness. So what you can see here on the x-axis is profitability, on the y-axis is fairness. This slider allows you to adjust the amount of money at risk. We assume for purposes of today that, like, this lender wants to keep the amount of money at risk constant. So the size of their loan book is currently $1 billion. And what you can see is this red dot represents the profitability and fairness at this lender if they had just decided on the basis of a credit score cut. The purple dot reflects the profitability and fairness of this lender's current algorithm. And what you can see here is the system identified an algorithm that was as profitable and dramatically fairer to Black applicants. And in fact, it identified one that was both more profitable and more fair. If you scroll down, you can see the juxtaposition of the current model and the proposed new Fairplay model. The current model approves roughly 50,000 loans. The new model approves roughly 380 loans. The current model has a default rate of 2%. The new model has a default rate of 1.9%. The size of the loan book remains constant. And lo and behold, look, the profitability is increased by $1 million. On the right, you see the fairness benefits. Women are approved under the new model at higher rates than the old model. And the most significant fairness dividend is exhibited by Black applicants who were approved by the previous algorithm at 68% the rate of white applicants and are now being approved at 99% the rate of white applicants. So virtual parity and fairness for other protected groups remains constant. If you want to understand, like, what is this model? What variables is it taking into account? And to what extent? How does it perform under stress tests? You just click on details, and we provide all of the information that's needed for a model risk management report of the form required by the federal financial regulators in something called SR 11.7. So you can see, for example, how the model performs during in-time and out-of-time tests. You can see a bit about the modeling technique. And most crucially, you can see what variables this model is taking into account and to what extent. Again, if you want that model risk management report for your regulators, you just click on Get Documentation, download, and you can see here a model risk management report of the sort required by the federal financial regulators that details the conceptual soundness of the model, the data used to build the model, how the model performed, and the governance regimes that are set up to make sure that this model doesn't pose a threat either to the safety and soundness of the institution that's using it or to the consumers it serves. Finally, let me just walk you through second look. So some lenders don't want to tune their existing models, but they are open to augmenting their existing models with what we call a second look models. And that's effectively a model that re-underwrites all the declined loan applications using one of the Fairplay models that has been tuned to be more sensitive to protected groups. So for example, you can see that we've preserved the same kind of visual nomenclature here, But the main difference is the slider on the right now, instead of being about dollars lent or money at risk, is now about accuracy impact. Are you willing to accept some diminution in accuracy? And if so, what does that mean for the economics of your portfolio and your fairness? So this lender, for example, was willing to accept a 3% diminution in accuracy. You can see that at 3% diminution in accuracy, the system identified roughly 5,000 additional loans for this lender to reconsider. So that the incumbent model approves 50,000 loans. Now augmented by the new model, this lender is making 55,000 loans. We were willing to accept a slight diminution in accuracy. So the default rate on the new loans is 2.1% compared to the incumbent, which is 2%. These are all additional loans. So the size of the loan book here has grown by $100 million. And lo and behold, profitability is increased by about 11%. And again, you get your fairness dividends on the right. If you want to understand who are these new Black applicants that the Fairplay model is identifying, what are their characteristics, you just click on population characteristics. And what you can see here is the Fairplay model is identifying different subpopulations that were missed by the incumbent model. And the Fairplay model is, for example, more tolerant of higher debt to income ratios, more tolerant of lower credit scores, and more tolerant of higher loan to value amounts. Anyway, that's a bit about us and our tool. Many thanks for the opportunity to share with you all today.